trading at its best?
Well, let me go ahead and introduce myself for those of you, if this is your first time to one of our webinars. I'm Mike Swanson, founder of TradeWest Forex. You've probably seen us recently releasing our product Momentix, and I've been trading for almost a decade now, full time. And I'm not going to get into all the background, but if you have some questions, you can definitely feel free to use the chat. But today's webinar is going to be about the modified carry trade. So I'll explain what that is. Some of you might have heard of carry trading. Maybe you've tried it and you didn't have a lot of success, and I'm going to explain why and give you a little background of how it works and a modified approach to trading it. So we'll be talking about what are interest rate differentials. I'll explain what that means. Sounds kind of complicated, but it's actually very easy to understand. We'll actually look at the common carry trade by itself before looking at the modified version, which involves using inflation rates to improve the method and the strategy. So let me go ahead and give me 1 second. Actually, one more thing here. We're going to go to the charts and look at trade examples, and that way I think that'll really help things sink in, when you get to see real examples on the charts. But before we do that, let me just go ahead and go over here to the blog. For those of you that haven't found the blog, it's just tradewestforex.com/blog. This is where we post the article about the topic, and then, as you guys know, usually at the end of the post we have a link to where you sign up for these webinars. And when you click there, this is also where we were going to post the replay. So if you end up having to leave early or you want to review any of our past weekly webinars, this is where you can access them. Okay, so now let me just go ahead and explain to you what the interest rate differentials are. Okay, so simply what that means is we're comparing two countries' central bank rates, or currencies' central bank rates. So if you're looking at the euro dollar, for example, you would want to find the central bank rate for the euro and the central bank rate for the dollar, subtract them, and that gives you that differential. And I'll show you where you can find that. I've actually posted a link right here on the blog where it says central bank rates. If you click there, that will take you over to their Forex Factory's website. And if you scroll down to the bottom left here, there's the central bank rates. And the nice thing about this resource is when you click them, they'll actually show you historical. And so, if I want to see what Australia, if I click on that, if I want to see what the past has looked like, right now it's 2.75, but if I click this little graph button, it will bring up, I can actually go ahead and scroll back all the way back to 2000. So it gives me quite a bit of data to look at. So I can see at one point their interest rates were 7.25, and then it dipped down to 3%. And then now we're at the lowest they've been in over a decade at 2.75. So that you can do that for each currency, or each currency. If we go back, close that one out, go back here, you can see here is the dollar. They give you a little more information there too about when it was last changed and last announced. But here is the dollar. Definitely a big drop on this one as well. It's been as high as 6.5, and then down to 2009, it just got locked in at less than 0.25%. And it's been like that for the last 4 years. So the reason we would like to look at history is when we go to our charts, if we're trying to build a strategy, we want to kind of be able to go back and maybe look at what you could have done the last year, last couple of years. You can go back a long time here, so you can get a lot of data to build your strategy. And we'll be going over some of that today on the charts and by looking at this resource. Okay. Now, so like I say, you're going to find those two currencies that are in your pair that you're going to trade. First, I guess the first step really is to find one that's high and then find one that's low. You want to find, not always are you going to look for the lowest and highest, because there's another part to this strategy, but most carry traders, that's all that they're doing. They're finding the highest, which is currently the Australia dollar, Australia currency, and the lowest is actually really the yen. They're at 0, but I just kept it easy with a commonly traded pair, Australia dollar here, and dollar is at a quarter. So your difference between the two is 2.5%, and so that's, in that case, what would you want to do here? You would want to buy the currency with the highest rate and borrow or sell the currency with the lowest rate. And what that does, it makes it so your position earns the difference of 2.5%. Now, what some people think is that that means you're earning 2.5% on whatever your trading account balance is, which obviously is not very good. Okay, what it really is, that's not what it is. It's actually you're earning it on your margin that you have on the trade. So, for example, if you're trading a standard lot, that's $100,000 in currency. So if you've bought the Australia dollar, if you do the math to see how much margin that position takes up, on an Australia dollar pair, it's very simple. It's exactly 100,000. Other pairs, you have to modify it by multiplying it by the rate. But anyway, Australia dollar is simple. You would, with one standard lot, you would own 100,000 in currency. Now, what that means is you're earning 2.5% on 100,000. You're earning $2,500. You're earning $2,500 in interest. So it's actually a lot more than people think. Now, the problem now here is that by trading the interest rate difference by itself, sure, you're earning $2,500, but if you've got a standard lot on the position, you will lose that $2,500 if the position, the Australia dollar, goes against you 250 pips, right? I don't know if my pen tool will work here. Let's see. Yeah, maybe it will. So if you have a 250 pip move with one standard lot, the standard lot's $10 per pip. That's $2,500. So the idea is, with this interest that you're making, the market needs to move less than that. If it moves more than that, then you're basically losing money. So that's the problem in your common normal carry trading strategy. So let me show you how we can improve this now. Okay, so let me clear that off. Okay, so the way we can improve that is trying to find out which direction that the market is more likely to move, or try to pick the times when it's going to stay at least neutral, because that's what gains you that interest rate. Preferably, we would, of course, want to try to get that direction right as well, because then we can just stack on more profits. So this is where we'll bring in the concept of inflation rates. Okay, so I'll come back to this. Let's first just go over some examples of just the basic carry trade. So if we go look at this right now, if we go back to, I'll use this link from the blog here, go back to the central bank rates. Let's just use our Australia dollar example. So we'll look at Australia, we'll go look at the graph, and we know that for the last, back in 2011 and 12, it would have been better. The higher interest rate, of course, would have been better here. But if we look at this really for the last, really this whole period, it's been at least what it currently is at 2.75. But what we want to do is we need to also go look at the dollar. We want to see how long the differential's been at least, close to 3%. We really want to see a differential of 3 to 4%. Now, of course, right now it's 2.5. It's not the best situation, but it's it's kind of your only options, and there's still some profit there that you can take advantage of. But if we say, okay, let's look at the dollar then. The dollar has been at a quarter since 2009. Really December 2008, but we'll just say January 2009. So even though this one's been strong the whole time, we really only want to go to our charts and only pay attention from January of 2009 till now, since that would have given us at least, looks like 3% up to 5 or 4.75, and then back down to 2.5, or yeah, 2.75 minus the quarter, so 2.5. So let's just go look at some charts now then. Let me go bring up some charts so we can see what it looked like. What did the Australia dollar currency pair look like for the last couple of years, back to 2009? Okay, so let me bring up a chart here. Okay, let's get the Australia dollar on. And we could even just stick it on a daily chart and maybe even weekly, just so we can see that whole period, see what the markets were like. Okay, so I'll just go put a marker on my chart in 2009 January. Okay, so what did we say to do if you have that positive interest rate differential? We said you want to buy the currency that has the high interest rate, sell the one with the low interest rate. Look what that would do for you here. If you did that right here, if you bought, let's get another color here. Okay, if you were just bought right there, you didn't do anything else, you didn't try to time it, if you just bought right here, even if you held the position all the way till today, okay, this is where, in this case, you actually made money. Not always will it work this way with just a straight carry trade. I'm sure this one probably matches the conditions I'm going to show you guys here in a minute with inflation. But if you bought from here to here, not only did you make that pip difference, which was, let's get our little tool out here. Currently that's 2,000 pips, 2,071 pips. I'm just going to get a little notepad up here for us. Okay, so you made 2,071 pips, but you also made the interest rate, which was for 2009, 10, 11, 12, 5.5. You got 2009, 10, 11, 12. You got 4.5 years. So you got four full years. So 4.5 years of earning interest. Which, if we looked back at our table here, I'll just go back to Forex Factory's central bank rate page here. We know that the dollar was neutral from that whole period, and looks like you could say our average interest rate was probably about, probably about 3.5, even if taking the quarter out. Okay, so if we have a 3.5% interest rate, okay, you're earning 3.5% interest. Remember, this is not just on your trading balance. You could have you have a $1,000 trading account. You might have traded a mini lot on there. That might be too aggressive. We'd have to, we'd have to check, but you'd have to check what your broker's leverage is and margins and things like that. But let's say you actually had, let's say you had 2,000 and you traded a mini lot. Okay, one mini lot is going to be 10,000 in currency for this pair. Okay, $10,000 in margin or $10,000 in currency. Now, what that means for that whole time you held it, you earned 3.5% on 10 grand. So, times 4.5 years. So the math's pretty simple here. You go 4.5 times 3.5 times 10,000 margin. Oops, I need to get that into a percentage. Divided by 100. $1,575 profit. That's just from the interest. So you see, you almost were able to double your account in 4.5 years just sitting on a trade doing nothing else. Does that make sense to everybody? Does that look like a nice little trading approach? I mean, this is why it's so popular and a lot of people are trying to figure it out, is because look how easy it would be. The method is so simple. You look at the interest rate differential and to just keep an eye on it every month or so when they release numbers. Check on the differential, and if you did nothing else though, if all you did was back in 2009, you entered the trade with a mini lot, bought the Australia because it has a higher rate, sold dollar with the lower rate, held it until that changes. It's been solid this whole time. Dollar has not changed their rates. Yeah, the rate has kind of dropped recently. You know, you're making 2.5 now, but overall average, you almost doubled your account just from the interest alone. Now, like I said, in this case, you also made 2,071 pips. So you made a lot more money from that too. You know, that's at a mini lot. That's $1 per pip. So you had another $2,071 profit from the move. Okay, so you more than doubled your account. You almost took a $2,000 account, almost $6,000 in, you know, it was 4.5 years, but there was nothing else. It was very easy trading. You know, this might not have to be your primary trading strategy, but it's something worth diversifying into, because, you know, you can still day trade and swing trade on the side, but you could have this sitting on there on your account, helping kind of offset intraday losses, or just, you know, build a, you could even set this up just on a small trading account and leave it alone and build a nice return. I mean, that might not look like a lot of money on $2,000, but as it compounds and continues to grow, it's definitely worth diversifying into. Now, like I said though here, this doesn't always work out that way. What if, for example, you didn't see it when it started back here, and maybe you didn't buy into it until somewhere here in 2011. Okay, let me go back to the Forex Factory page here. Okay, if you did it in 2011, well, that looked like the best time to do it. This is when most people were probably jumping on it. 2011, it was sitting at 4.75, and we know that the dollar was at a quarter. Okay, so you would have had a 4.5% interest rate. Okay, so 4.5. Now let's go back to the chart. If you see what happens, everybody is jumping in here saying, okay, I'm going to earn a nice 4.5% holding this trade. Well, remember what I said? If the market moves against you 450 pips, you are, you know, in a year, you're losing that interest. You're not making anything. Well, here in 12 months from that point, 12 months, yeah, it didn't really move too far, 200 pips, so you got about half your profit, but over the next year, you got nailed. You know, you're looking at, let's see, that wasn't quite a full year. I was thinking we were on a monthly chart. Okay, so from May to, let's go to May in 2012. Okay, so right here. So actually, yeah, you're down 600 pips in a year. So you actually lost money doing the carry trade in that case. Actually, how many of you have tried the carry trade approach this way that I'm showing you guys? Just the basic trade, that, you know, buy the high rate, sell the low rate, and just hold it and hope it's going to make you money from the interest, and maybe that you're right on the direction. How many of you have traded that way before, or maybe you still do it right now? Or if this is completely new to you, maybe type in new. If this is all new stuff, you've never heard of this trading style, type in new. I just want to kind of see where everybody's at here in the webinar today. Okay. It does look like most of you are saying it's all new information. Okay, well that's good then. I'm glad to see, because, you know, it's hard to probably see that this is going to be profitable if you've gotten beat up in the past following the basic approach. Because like I've just shown you, there's times that you can be right and it's a great setup. You make a ton of money. But if you're late on it, or you're not trying to time this in any way, then you can get hurt. You can get it in at the wrong time, and it's just not even worth it then. Okay, so let me show you the modified approach now. What we're going to do is we're going to look at one more statistic, one more fundamental. And let me show you where you can get that. Okay, over here on the blog, we've posted the link to the inflation rates. Now, this isn't a direct link. I'm going to have to show you how to get to it, but you're going to want to look at the CPI. So if I click on inflation rates here, not always is there going to be CPI for the week. You might have to actually hit more a couple times until you find a CPI report for the currency you're looking for. But here for Australia dollar, the CPI, it comes out every quarter. So we can click this little graph and see the same type of thing that we've seen with the interest rates. Is we can see what this really reflects here is inflation. It's the consumer price index. So what we want to see is the CPI, lower than 2 to 3% for the currency pair that we're going to trade. We want both of them, both the dollar and the Australia in this case. Both those we want to see under 2% if we can. 3 is kind of a little more aggressive because things be more volatile and you can actually move the opposite direction like we were seeing on the Australia dollar pair. But you can see Australia has been pretty good. But for this 2009 period that we're looking at, it's never gone over 1.6%. So their currency is good. It's a good one to trade. But now let's see if we pair it up against the dollar. Let's go look at the dollar CPI. Okay, so it looks like CAD CPI came out this month. So I just hit Control F. That'll help me find it faster. I don't know if they have another filter in here. Let me see here. No, I don't think so. But anyways, it'll take you a little bit of work here, not long though, to go and find when the last US CPI was, or you could even just Google it and then come back here and go to that date, which we could probably even do that, save ourselves some time here. I was trying to find, I had another resource that I used to use that had it all in one place, but I couldn't find the link. But that's all right. We can type in here on Google US CPI rate. And then you can do 2013 even. July 16th is what it sounds like. So let's go see if that's right. So yeah, we'll just need to scroll up to that date. We could even just hit the calendar here, go to the 16th. I'll even apply a little buffer on there. Okay, New Zealand came out, pound came out, and dollar. They all came out really around this time. So there's the dollar CPI. Okay, so if we click that little graph again for the dollar, we can see that the CPI for the dollar has been, okay, it's actually been, looks like 0.1. It's also been very low. Okay, so we would expect the volatility between the currencies, or on that currency pair, to remain somewhat constant when both of them don't have a very high inflation rate. So give me 1 second. I'm going to see if I can also find this. I think I have this link up in my history. I can grab it. It'll make this a little easier. Give me just 1 minute here. Okay. What I'll do is, while I'm grabbing this real quick, we'll just, if you guys have any questions, you so far. You can go ahead and type those in. I'll just be another minute. Give me one more minute here. We have a question is, with the US dollar, what does less than 0.25% mean? Why isn't the rate exactly 0.25 or exactly 0 and not some undefined percentage in between? Actually, I haven't even really tried to dig into that to see, I haven't paid a lot of attention to it. I've seen that in the past it had always been the yen that had done that, but now the dollar's at the same thing, at the same level. It seems like the yen is now actually 0, but that's a good question. I haven't really bothered to look into that. It could be that throughout the year, sometimes it does fluctuate between 0 and a quarter, but we'd have to confirm and double check on that. Okay, I've just about got this, guys. Give me one more minute. Any other questions, you can definitely let me know, and I'll get those answered for you here before we continue. Oh, yeah. Andy was saying under the filter on Forex Factory, you can also apply the currency filter to narrow it down to just Australia and US dollar then, and all the red events. So that'll make it easier to find it. So that's a good tip. Okay. Okay, so I couldn't find that link. I don't want to waste any more time here. I'll just, if I end up finding it, I can post it in the blog. But that's all right. Let's jump back here, and I'll show you the next step here, okay? So here's the thing now. We were looking at the Australia currency versus the US dollar, and both of them do have lower inflation rates. But however, if we looked at the Australia dollar currency pair that we were on, there was still quite a bit of volatility here in this, especially in this the last few months mainly. Okay. Well, this is the thing. Like I was saying earlier, you really want to try and trade these when the interest rate differential is above 3%. In this case, we were at 2.5. So let me show you something here. If you were trading this back here or even here, what you would want to do is, let's go find the point when it dropped off of 3% here. Okay, so if I go back to the interest, we know the dollar stayed neutral, but the Australia dollar, let's go back here. Okay, if we go back to the bank rates, go down to Australia, we know that it dropped off at one point. We want to go see when that was. Okay, so we were at a quarter, so it's whenever this dropped below 3%, which happened, or dropped to 3%. Okay, it dropped to 3% on Looks like right on December 3rd, 2012. Okay, so at December 3rd, 2012, we want to go back and look at the charts now and see what happened then. Okay, so let me go back here. December 3rd, 2012, right? Look at that. It was right before all this movement down. So December 3rd was right in here. Okay, that's when you would want to pull away from trading this particular pair because of that interest rate differential falling. Okay, so now if you were buying here like we said, or even bought at the worst price, you know, you wouldn't be doing so bad. You actually would have been able to make at least a little bit as a worst case scenario here. And that's just applying a basic filter of, in this case it was interest rate differential falling below 3%. If the inflation rates would have, either one of the currencies would have went above 2%, 2 to 3%, then we would want to also close the trade or stop looking at those trades. I'll show you some more examples. This one was probably not the best. Both of them didn't have a very high inflation rate. What caused this one to drive down was lack of high interest rates, and that's why it's getting sold short now, is because the people are pulling out of the Australia currency as well, because they've been lowering their interest rates as of this point right here. And they dropped it again here, and now it's really just taken off. But you know, I'm going to show you some more examples. The other thing here too that you can do is don't just trade this Australia dollar pair by itself. Try to build a couple of these trades together, so you can help limit your risk that way too. You know, by having a basket of trades or just a portfolio of carry trades. That way, if something like this, you know, if one of the pairs just gets really weak and takes off, well, I mean, a currency gets weak and takes off, then another pair without that currency might help offset it. I'll show you what I mean here. Let's go get another example. We have a question about this interest rate differential is obviously for position trading, but does it ever factor into your swing trading? Yeah, you could definitely, you know, use this as ways of determining the direction you want to trade a pair, for example. You know, anytime from 2009 here to end of 2012, you would know that there's pressure on the dollar and strength in the US and the Australia dollar, so you'd want to stay long only. If you notice, the short opportunities were pretty limited because of all of this. It didn't start to head down until the interest rates started getting lowered. Okay. So let's get another example. Let me just go back to the page here. Let's see. Okay. So here is the page again where we can go back and look at the interest rates differential for different pairs. Now, the next one down is really the New Zealand. See, right now, you're going to probably have to wait till the next quarter, wait till these rates start to go back up. They're all getting down pretty low. Australia was the last one to go, it seems. They held pretty strong until just recently. Their rates have come down as well. But let's just go look at some historical ones still against the Australia pair. We'll keep it back in December when it was still at over 3%. So let's go compare it against the pound. Okay, so you know, pound Australia currency. Okay, the pound has dropped their rates to 0.5%, just like the dollar in 2009. They've left it at 0.5%. Okay, so if we go look at the pound Australia currency pair now, right here. Okay, there's 2009. You would want to be selling the pound because it has the lower rate and buying Australia. So this is the flip side because of the way the pair is set up. But anyways, you'd be selling this one. So this one, again, same type of thing. It was when the Australia rates were high and strong, it was driving the pound Australia down. you know, 7,800 pips. But here towards the end, just like Australia dollar, it's starting to go the other way because of the rates getting lowered on Australia with the Australia pair or currency. So let me go back now. Let's look at inflation. Let's apply the filter and see when that changed, if that changes anything. So if we go back to let's go back to the CPI page. We can do like Andy mentioned, and we could go into filter, tell it to only show us the red and only for the pound in Australia. And that way I could get to it a lot quicker. So there's Australia's CPI, and I thought we saw the pound CPI in here. I think we have to go back to the previous week. Yeah, pound CPI. You know, I just realized too, I think we were looking at the monthly report. I'll have to double check on that for the others, but we want to be looking at the year report, so the yearly rate. I'll double check that. But see, here's the yearly rate for the pound. You see how the pound's inflation rate has always been really high? Okay, so it's only ever been below 2% for a short little period in 2009. Looks like July 14th to December. So July to December 09 was the only time you would really want to be trading the pound Australia. So let me go look at that one then. July 09 to December of 09. Let's go back to the chart. Okay, so if we go mark on here where that's at, July 09 would be right over here. You'll notice too, this is going to be the best times. When that inflation rate is down and then you have the highest differential, you have the best chance of being on the right side of the market while earning the interest rate as well. So there's July 09 to December, and you'll see how you caught the big chunk. So December's right in here. You caught that, you know, pretty much the biggest chunk of the move, really fastest move was about 2,600 pips in just those 6 months. So not only made 2,600 pips, but you earned the interest rate difference, which we could go back if we want, and we could look at that time what the differential was. Okay, we know that the pound is 0.5%, and Australia was from July to December. Looks like December it was up to about 3.75. So you're averaging probably about 3.5%, or about 3%. You're right at that 3% mark after subtracting and get the difference. Okay, so 3%. So for 6 months on that mini lot account, you would have made another $150 per mini lot traded, and then you've made that 2,000 pips. Okay, but like I said, we use this as a filter now because the rest of the time it would have been dangerous to trade that pair because of the high inflation rate on the pound. It causes a lot of volatility. Let me just double check now, like I said, on the make sure we're looking at that yearly CPI rate. Let's see, Australia's. There's Australia. Okay, we probably were looking at quarter because there's the quarterly CPI, and that's why we were seeing these lower numbers. But I mean, we should be able to find the year. Let's just see here. Oops. Oh, I can only go 60 days. Okay, so let's see, that's January and February. Like I said, if I can find that other link that has all this stuff in one place, I will post it in the blog. Doing historical is a little more difficult. Just getting the current numbers is pretty simple, but okay, let's check that period. Let me do another little search on Google for this for us to find a date. Yeah, I know they have inflation calendars like this for each, like this is for the dollar. And you could definitely go out and find it that way. So this gives it to us for the dollar at least. We can see that the annual inflation rate was sitting at 1.8, 1.7, but you see here in 2011, 3%. So see, we were over 2%. Even in 2010, we were over. So 2010 and or 2009 and 2011, especially 11, we were pretty high on inflation for the dollar. So if we went back to our charts and looked at 11 for the Australia dollar, you will see here that that is when there was all that volatility and the market was falling. So see, if you were here trying to decide in 2011, should you buy Australia dollar, you would probably not want to do it because the dollar had a high inflation rate. You would want to wait till 2012 when inflation came back to normal. We'd have to go check Australia's as well, but here would have been a much better place to do it. And then as we know, the differential changed there, and now you're making money on it. Okay, let's see if we can go grab Australia's inflation rate table, and then we'll kind of summarize everything. Okay. So here is, let's see, that's probably not going to give us a graph. This is a lot of just, they can give you the numbers sometimes in these little posts, but I wanted to see if I could find a graph like we found for the dollar. Might be able to find it in images. There you go. So this one's not very clear, but we can still see that even Australia had over 3% inflation until beginning of 2012. So same thing. Right in that period would have been the best time to trade Australia dollar, was right at the beginning of 2012 or beginning of 2009. And just like we saw on the charts, that matches up. So you see how this little modification can help you trade this method during those best times? Beginning of 2009, great move. Into 2010, Australia had a high inflation rate. Market got volatile and whipsawed back the other way. Back in 2010, good again. 2011, dollar had a high interest rate. Market gets choppy and pulls back. A lot of volatility. 2012, both of them are good again. You still have a good differential. Market moves up. It does whip down again here, and this is when the Australia started cutting rates, and they did it all the way till about right here is the last point you could trade it. Okay, so hopefully I've given you enough examples and ideas. You can do this on any currency pairs and all currencies. You should be able to go through and practice this a little bit, spot places where you can come on here and mark it off where you could trade these with that little filter. You'll see that it'll help you be on the right side. It's not always going to work perfectly, but having that filter is going to help you not only make the interest rate while you hold it, but know when to get out and know when to time the entry. I see a few questions here, so I'll go ahead and answer some questions, and then we'll wrap it up. The carry trade is better with more leverage, right? So it's better for non-U.S. traders who can access greater than 51 leverage. Well, leverage is just going to decide on how aggressive you can trade it, really. You could still carry trade, and even with this modified approach, with 50-to-1 leverage. It might just limit you from putting aggressive positions on. You're just going to have to make sure that you're paying attention to what kind of drawdown to expect. So really, if you're looking at a 3 or 4% differential, you know that If the market goes against you 300 or 400 pips, you are losing money on the difference. But that doesn't necessarily mean you might want to get out. You might want to have a little more buffer than that. You know, you might want to have a buffer of twice the amount of the differential. And so you need to then calculate your margins based on that. And you know, even at 50 to 1, you might find you can still trade. We'd have to do some math to see for sure. But if you're looking at, let's say you're looking at 500 pips that you're trying to give yourself room. Well, if you have a mini lot on, that's going to cost you in margin on your account at 50 to 1. It's going to cost you the rate of the currency times the position size. So you're at 0.91. At 50 to 1, you have to double it. So at 50 to 1, it's going to cost you about 18,000 in margin per mini lot. So, you know, if you figure out, okay, you've got a $1,000 account. If you have a $1,000 account, I don't want to try to confuse you guys with this. This is probably for a different lesson, but try to give you a quick example here. Is basically at $1,000, if you take and trade a mini lot, you've got 18,000 of your 50,000 because they give you 50 to 1. You've got 18,000 of your 50,000 margin in use. Okay, let's get the notepad up here so I can at least make some sense of this visually here for you. Okay, so if you've got the currency rate is 0.9187, okay, at 50 to 1, normally you just times that by, you know, if you're trading a mini lot, you'll just times it by 10,000. Okay, you know, that's going to, you can do the math here if you want, but it's pretty simple. You know, 0.9187 times 10,000, 9,187. This is based on 100 to 1 leverage, though. Okay, so now if we're at 50 to 1, it's going to cost us twice as much margin. So, you know, at 50 to 1, it's going to be 2 times 9187. You got 18,374. And then if you've got a $1,000 trading account, then you've got a 50,000 in margin. Okay, so you go 1,000 is 50 times 1,000. So you've got 50,000 in margin. So if you've used 18,374 in margin out of your 50, it was fine. You got filled. So you had no problem trading a mini lot, even on just $1,000. If you're going to trade a couple pairs at a time, then you've got to be careful. You could really only take 2 at a time, and if it's another pair, you have to do the math again and see. But you need to make sure you're not over leveraging and just calculating how much room you're going to need as well. So that's the second part of this now. If the market goes against me 500 pips, that's $500, which is at 50 to 1. That's actually 1,000. You times it by your, if you've got $500, that's actually times 50. So in your margin, that is 25,000 in margin drawdown that you have to account for. It's going to be 50 times 500. Okay, we got that from, it's 500 pips at $1 per pip times our leverage. So that's going to be 25,000 in drawdown margin that you need. So you have to see, do you have the room? You've got 50,000 total. You subtract 18,000 and subtract another 25. So you have enough room. It's tight. That's why that might be still too aggressive, and it might even be too aggressive for your trading. What you're comfortable with, your risk tolerance. So that would put you, at 43,000. So you still got 7,000 left. Now, of course, if it goes more than 500 pips, if it went to 600, you'd probably be margin called. Actually, about 700, right around there. So that's what you got to do the math and account for here. That's why I say when I was doing the example earlier, you probably are going to want 2,000 to do a mini, and then that gives you a lot more room. So hopefully, I mean, I didn't plan on doing this as in the webinar today. This is for probably a different lesson, and even in our 101 we've talked more about calculating margins and doing this, but I just want you guys to make sure that you're not overlooking this piece, because you don't want to get margin called in a carry trade. That can ruin everything. But as you can see, you don't necessarily have to have higher than 50 to 1. Just make sure your balance and your minimum lot sizes and everything match up. So if you have to review this one again, it's all recorded, but just make sure you're paying attention to that little detail there. Okay, let's see, any other questions? The URL for the recording, just go to the TradeWestForex.com/blog, and you will find the link to I'll also post it here in the webinar, but just want you guys to always know how you can get back to it. If you just go to the blog at TradeWestForex.com/blog, any one of our posts we link, usually at the end of it right here, to weekly webinars. You could probably even type in weekly, or just webinar in the search right there, and you can see it found a post right here, and there's webinars. So you just click on that link there. It takes you to TradeWestForex.com/webinar/weekly. There's all the replays. So I'll just post this link right now in the chat for everybody as well. Okay, how do you trade US dollar Indian rupee? Interest rate is 7%, inflation is 8%. This pair has been going up for years. Well, that's what you got to be careful about, though, with that high inflation rate. Usually things are too volatile, and it's hard to be on the correct side and time it. We don't like to have inflation rates over 2%. But if we're going to try to skip that rule and trade it, then you would want to be selling you'd actually be selling the dollar and buying, doing the opposite. But what you're finding is a currency pair that has a high interest rate and high inflation. So that usually has the opposite effect on the pair. So that's why you're seeing the dollar going up while the other currency is going down. So I mean, that's a different strategy, but where you just basically trade the opposite, but it's a little more risky. Andy says, can you show us it applied to the current market as opposed to the historical market? Well, we kind of somewhat did the current. There's nothing that's perfect right now. The problem right now is with the major currency pairs, at least, is that the Australia rate now has recently dropped too low. They just barely in May dropped it to where now the differential is under 3%, which is not what we like. You could still trade it, it's just not going to be as accurate. You're going to find more drawdowns because less traders are investing in the Australia, interest rate investments and different instruments and things that affect that. That's actually pushing the currency down. So if we were looking at this, though, like I've been doing going back, the last best time to trade this really would have been in, before the end of last year when it was at 3 1/4. You might still be able to trade it. It's sitting at 2.75 right now. You might still be able to trade it against the yen. Let me go in here and just filter it down to the yen. Let's go see what the yen looks like. Oops. Just going to go find out see if we can get the CPI on the yen. We might want to just Google that one too. Let's see. It might be this website right here, tradingeconomics.com. That might be the one. Yep, that is it. Well, I'll update the blog as well, but this is that page I was looking for. that I've always used for looking at both inflation and interest rate. It's all on this page. Okay, so you can see inflation rate right here. You click that, and then you can pick the country, and you can see here's Japan. You know, we got Japan up. Their inflation rate has actually been, it's actually been negative. So it's definitely below the 2%. And then if we changed to Australia, give it a minute to load here. Okay, we just lost sound there for a minute, so everything's back now. Okay, so let me go ahead and go back to that. Then you can go to, we can go back to Australia, and we can hit, instead of using CPI, that's what we had to look for on Forex Factory. I'll just go to actual inflation rate. That'll give us the yearly and actually more of what we're looking for. And then I can go pick the country. I can go to Australia, and we can see, say I think we had to go back under, is it under money? Can't remember what tab it's under here now. Consumer probably. Well, let me see here. Okay, it's under prices. So they've put inflation rate under right there under prices. So if we click on that, now we're seeing Australia inflation rate. So there you can see how, right now currently it's at 2.5%. So even with that, we really don't want to really, it's more dangerous to trade this Australia in any carry trade because of the higher inflation. We say kind of 2 to 3%, but we really prefer to be about 2. So that's the thing. Right now, currently, we kind of need to wait for things to settle back down. You could still do it. I can tell you now, if you still want to try to take some trades now based on it, what you can do is look at, look at the yen. Then it'll give us a little bit higher differential. We've looked at the yen. We looked at Japan's inflation rate, and everything was good there. Under price, inflation. You can see everything's good on that, but let's look at the interest rates. See where they're hiding that. Okay, interest rate, it's under money. So there, you know, we see it sitting at 0. So we know that from Forex Factory 2, but that's how you can see, you can get all that information on this page, and a little easier than trying to search for it. Like I say, I'll update the blog with this link. Okay, so now let's go back to the chart then and look at the Australia yen. Okay, buying Australia, selling yen. You can see this one's been pretty good up till April when Australia started dropping the rates further and inflation went up. So see, there's your risk, is if you trade with the higher inflation and the lower differential, market prices will likely fall. But now that it's at a better price, it's at support, you could use some technicals and still possibly take the trade now, and just keep a close eye on things. Watch for the next reports. I think Andy said something's coming out on the 25th, and adjust things based on each quarter or each time that one of those reports are coming out. And you might even look at some of the more exotic pairs or currencies that aren't very commonly traded, like someone was pointed out with the Indian rupee, things like that. Some of the majors right now just don't have very high interest rates. The last couple months they've dropped them. Okay, well, I think we've covered quite a bit today. If you need to review this, I've showed you where you can get the replay. I'll also update that blog with that other link to the Trading Economics page, and we will let you know next week what the next topic will be about. And if you have any questions about what we talked about today, feel free to shoot us an email. So thanks everybody for coming. I hope you have a great weekend, and we'll talk with you next week.